Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Well, we just ran you through all the stocks that we're tracking for you. So let's get a little bit more specific. We have Prakash Diwan who's joining in to help us out with some fundamental analysis on all of them. Hi, Prakash. Good morning. Thanks so much for joining. And I hope you had a good weekend, Prakash. Well, plenty of stocks, plenty of result reactions as well that we got over the weekend. And one number that looked good. Let's start off the good first. You had Just Dial. Those numbers look pretty good. Good cash balance as well. Growth is coming about. Margins looking up. Your view on the stock?
Good morning, Nigel. Yes, thanks. Yeah, I did have a lovely weekend. So I think the results over the weekend have been a mixed bag with Just Dial, possibly the only silver lining in this otherwise muted numbers. And what's interesting about the numbers from Just Dial is that they've started seeing operational improvement, and it's not like, one-offs which has led to this, change. And I think the fact that they have still not gone ahead and marched ahead with revenue growth impetus, it's more of, a refining of the margins that's happened. And that refinement process, that entire, debottlenecking in their processes is something which they spoke about some time back. And that's what's resulted into this thing. So they will rationalize, I think you'll continue to rationalize their mix in terms of, client mix and in terms of the services. And they would, if they were to start focusing on that with this kind of, cash on the books, there's lots that can be done. So the optionality goes up if your basic operational metrics are in place. So that's finally happened on this particular quarterly numbers. And I hope that they kind of continue to improve on that, because this is work in progress for sure. But my sense is that people will wait to see this endorsement of this improvement, maybe for one more quarter before they kind of jump in. So it has been low on the institutional appetite. It will only change if some sort of a continuity is indicated from the operational mix. So that's what I would wait for. But yes, it's a great turnaround of sorts in terms of the trajectory of where it was headed.
And something perhaps the street has been recognizing, right? I mean, in the last 3 months, the stock is up 30%. But let's talk about some weak numbers as well. The problem with Avenue Supermarts is that not only is it a second quarter in a row where, margins have been under pressure, management commentary is not great. But despite the valuations getting adjusted downwards a bit, it's still trading at 70 times forward. So do you think that there will be a lot more downgrades coming through on Avenue Supermarts? And what do you do as a long-term investor in this stock now, Prakash?
Good morning, Sonia. So you're right. This has been the darling of the market and the retail segment. It's been the poster child of sorts. But where it's hurting is, the other players, which probably are more unsung heroes, the likes of Zudio and Trent and all of them, they have actually eaten into a significant mind share and now wallet share on the general merchandise and the apparel side. So, if you step into a Zudio outlet, you'll kind of realize the kind of, the propensity for people, the footfall conversion into sales is so high as compared to DMart, where probably the average ticket sales haven't really inched up above the pre-pandemic level. So probably I think their focus is more on broad basing themselves. They've expanded quite a bit. So, you will have this kind of time taken to stabilize, but it is an expensive stock. So, you really, the issue is that if it's so expensive in terms of valuation, so rich, you probably don't want to see any kind of a letdown in numbers, right? So, I mean, it's priced to perfection in that sense. So any letdown will possibly result into some sort of a setback on the expectations of the street. My sense is the margin improvement, if it is the growth outlook is not very positive going forward, there will be some sort of compression that the street will start penciling in, and which means at least about a 10 to 15% kind of a downside from here, which is quite significant for the street. So for long-term investors, it's best to tide over this phase by staying in. It'll probably go through a time correction and a consolidation. Don't get disheartened if you've got it at lower levels. I'm sure there's enough cushion for most investors who have bought in at lower levels, but don't expect a scorching growth from here on as some of the other players have done. You'll have to probably bide your time. That's the only thing that these numbers tell you.
Prakash, hi, good morning. IT services stocks, right? I mean, this week Q1 was so well advertised, and we were talking about it before the earnings season started, that maybe numbers will be bad, but will the markets react? They reacted, but on the upside, because I guess it was well known that Q1 will be weak. But what now, you think? Because last week has been good generally, despite poor numbers.
Good morning, Prashant. So absolutely, I think it's all to do with positioning. We spoke about this last week when a couple of those numbers came through, that the street was probably anticipating the worst kind of a situation where, the recession would hit them hard and, things would not kind of look up or would take too long to start looking up. But the commentary that has come in, the body language of the managements, let's say HCL Tech, I mean, while they had weak numbers, they were absolutely unperturbed about the guidance for the rest of the 3 quarters. So it tells you that probably the bottoming out process is what you are seeing at this point in time. The same thing was with Wipro. I mean, Wipro improved some of their metrics. The expectation was too low, and it started looking so positive. So my sense is that your entire setup will probably start recalibrating itself in terms of what kind of growth to look at. So growth versus time, if you were to evaluate that from a PEG basis, these stocks probably don't look as expensive because growth will come back in the subsequent years or subsequent quarters at least. Now, the worrisome part is that some of these companies probably still don't have what you call, a very high expectation in terms of growth. So any PE expansion will also be restricted. It's not that, suddenly people are buying into it with a 20-30% kind of an upside expectation over the next few quarters. But the fact that all the short sellers have probably had to be kind of, swearing off their positions is what's led to this kind of a bounce. I would believe it will probably consolidate a bit going forward. And the mid-cap companies, the IT companies, which probably next week onwards you'll start seeing some numbers come through, will probably do very well. The likes of Cyient, Coforge, Sonata. So that pack of companies is going to probably show you even stronger numbers because they have been more agile, more recession-proof in that sense. And if the US data is turning positive, IT will get its positive headwinds to sail along.
Okay, Prakash, we'll just come back to you in a bit.